Hello, welcome everyone.
Mhm.
We have gathered here today actually from all over the world. We have people from the US, from the United Kingdom, from India, from Bangladesh and the Nordic countries, and many more places. So I'm very happy to see so much interest in this webinar. It's great to have all of you here today. So the topic today is money. Should the state issue its own money in competition with private banks? To understand why this subject is important, so let me just provide a short background before I'm introducing our guest here today. So today, private banks have been given the power to create new money that they lend to customers or use for buying assets. So this is highly profitable and gives the banks huge power over the economy. This has led to a misallocation of money. Too much has been created for buying assets and real estate, which increased the economic disparities, that increased the risk for price bubbles and financial crisis. But in 2016, the Swedish central bank was actually I think first in the world to start to investigate whether they should challenge the bank's monopoly over digital money creation. Eventually, others followed, and now central banks all over the world are investigating whether they should issue digital currencies. So, however, this development, it has not been without resistance from the banks. They know what power they can lose, and they fear it. So when the Swedish central bank launched their first CBDC report, the Bankers Association protested loudly, and the debate has been going on ever since. So state-issued money, it would be expensive for the taxpayers, it would lead to bankruptcy, it would lead to financial collapse. The proposal was called a risky social experiment by Nordea, the largest bank in Sweden. The newspapers wrote that Swedish bankers, they face an identity crisis over the digital currency plans, that the bankers fear for their deposit base, that the CBDC will threaten the bank's monopoly profits, it would lead to a nightmare where the state controls everything, etc., etc. So the deputy governor of the Swedish central bank scoffed at all of the bank's objections and said, there seems to be no limit to what would happen if we introduced just this little e-krona. But the protests put a spanner in the works. The Swedish central bank was not allowed to proceed on their own. Instead, they had to argue again and again that a government inquiry should be set up as soon as possible. However, the appointment of this inquiry was delayed more than 1.5 years. In the meantime, while the inquiry was running, the Bankers Association, they managed to ensure that a Nobel Prize, a so-called Nobel Prize, was awarded for the theory that banks don't create money at all. They just work as intermediaries between borrowers and savers. This prize, it raised a storm. So professors of economics and journalists all over the world, they protested. So here's just a few examples. I will not read all of them, but I have to move around my Zoom stuff here. The Nobel Prize has set monetary policy back 50 years. And I don't understand why the Nobel Committee has chosen to reward people who have got things so disastrously wrong. And it's if the Catholic Church not merely tried Galileo, but also destroyed all knowledge of his telescope. So, both in the academics and in popular media, the prize has been used to argue that we don't need a CBDC. A central bank digital currency, it's dangerous. It would cause disintermediation of the banks. And always remember that we have to rescue banks and give them generous subsidies and benefits. Otherwise, we're all doomed. So finally, 2.5 years later, with the postponed deadline, the state inquiry presented their conclusions. And their conclusions were, state-issued money is associated with great risks. Don't do it, don't implement this. But since the central bank seems to think it's important, so let them investigate the subject instead next year. So we have only investigated if it is a good idea right now, this year, 2023. If it's a good idea now to issue it. But we have no idea if it's a good idea tomorrow, 2024, then maybe. Yeah. So in other words, this investigation, I see it just an ugly trick to buy more time and prolong the process further. It was 1,317 pages, and they just throw the ball back to the central bank again. So this means that in 8 years, we have gotten almost nowhere. From being first in the world here in Sweden, we have now become overtaken by other countries that already has introduced the CBDC. So this is why we are organizing this webinar. Several biased ideas about state money have been spread recent years. This has prolonged the private banks' power over money creation and safeguarded their profits. But we want a serious scientific discussion about what would be the best for the society as a whole, and understand the central bank digital currencies more deeply here. So therefore, we have invited Dr. Michael Kumhof from Bank of England. So you are very welcome to today. So just to introduce you here, I have to take away my Zoom stuff again. So Michael Kumhof, he's a leading researcher on banks and monetary systems. And now he's working as a senior research advisor in the research hub of the Bank of England. And before that, he worked as a deputy division chief at the modeling division in the research department at the International Monetary Fund. And there he was responsible for developing the global integrated monetary and fiscal model, which is used at several central banks for IMF's policy and scenario analysis, and for the world economic outlooks, etc., etc. And Michael, he has written, before that, he was assistant professor at Stanford University. And Michael has written several influential papers in this subject. So one is, for example, the Chicago Plan Revisited from 2012, I think. And also this paper, the intermediary model, that banks are not intermediaries of loanable funds. Now he has written this brand new paper, CBDC Policies in Open Economics, that is super interesting. Before we start, just who are we that are organizing this event? So we are from the International Movement for Monetary Reform, and we exist in 29 countries. And this webinar is a cooperation between some of us. And my name is Samuel, and I'm from the Swedish branch, Positiva Pengar. And with us here today, we also have Lucille from Alliance for Just Money in the US that will help us with discussion and questions, and Ryan that helps us with Zoom and the technical stuff. So that said, the agenda today, so Michael will have his presentation for around 60 minutes, then we will have a short break, 5 minutes, and then I will have a short interview with Michael 10 to 50 minutes, and then it's time for questions from the audience. So this is the plan. And you will all be muted now, so please save your questions until part 4. Then you can raise your Zoom hand and unmute when it's your turn to speak. And then you will also be able to post questions in the chat to everyone. So save that until it's time for question. And one last thing, please respect that Michael, he's from Bank of England, and he cannot comment on political opinions and stuff like that. He will only present his research and answer questions about his research. So with that said, a warm welcome to all of you, and a special welcome to our guest here, Michael Kumhof.
Good evening, everyone. Impressive attendance for the early evening, so thank you all for coming. Before I say anything, I really want to emphasize that Samuel just expressed a number of strong opinions. That has nothing to do with me. As he said at the end, I am only presenting the results of my research, and I want to be careful about making any kind of political statements. I'm not. So I'm going to be presenting the results of our most recent work on CBDC, but weaving in some details from previous papers that I've written, because it's relevant to understanding how CBDC would work. So I'm going to share my screen now. So that the title of this paper is CBDC Policies in Open Economies. It's joint work, and note that I appear here with my affiliation at the CEPR, because this paper was not issued, has not yet been issued as a Bank of England working paper. The Bank of England has its own process going on. You would have seen in March, if you're very interested in this subject, a consultation paper came out, and the consultation is not over yet, where the Bank of England solicited opinions on its plans. And so this is in no way meant to interfere with that, and it differs in some details. And so it does not reflect the official position of the Bank of England as of now, although it has to be said that the position of the Bank of England is very much still in a phase of let's think about it, let's research it, and let's hear what others have to say about what we're thinking, which I think is exactly the right thing to do, of course, at this point. Marco Pinchetti is a colleague of mine. He also has an affiliation with an outside institution, the Center for Macroeconomics, listed here. Purachai Rungcharoenkitkul is at the Bank of Thailand currently, and still affiliated with the BIS, and Andrei Sokol is at Bloomberg. He was previously also a colleague of mine. And the usual disclaimer applies. As I said, it's in fact a stronger disclaimer than usual as far as I'm concerned here. So to introduce the subject, as you all know, a major share of the world's central banks are actively studying the subject of CBDC, central bank digital currencies. And the focus has been mostly on microeconomics and technologies and what will this do for society, but not thinking so much about macroeconomics. There is, of course, research on that. In fact, we were first on that with our working paper in 2016, which I presented at Riksbank back in 2016 as well. But not that much more work has been done on it, a few papers, but not a whole lot. And the topics that we find have received especially little attention, and that we're covering in this paper, is steady-state efficiency gains due to CBDC, i.e. how much more output and welfare could an economy produce permanently if CBDC was in the economy, then the use of CBDC policy rules in order to stabilize the economy when it's subject to shocks and crises and what have you, The open economy dimension is the capital flows, exchange rate volatility, and also the effects of CBDC convertibility rules on banks. This is a subject very close to my heart. I wrote a paper about that with Claire Noon, who is now at the Reserve Bank of Australia, about how CBDC should be issued, and it differs from the proposals that have been made by most of the central banks out there. And I'll talk about this because it answers directly to the concern of commercial banks with financial stability. So I'm an economic theorist. I originally come out of academia, and so I'm going to use a dynamic model in order to study these effects, because that's what central bankers do in order to study the effects of their existing policies and potentially new policies. And this is also what academia does. And we want to basically build on what's already out there in order to study CBDC specifically. Now, the question is, what is CBDC? For the purpose of this paper, it represents access to the central bank's balance sheet. The item CBDC is listed on the liability side of the central bank's balance sheet, although, as I've argued in another paper with some top-notch legal scholars, it is not should not properly be listed as a liability of the central bank, but rather as something much closer to equity. But that's a question for another day. It's assumed to be universal, meaning banks, firms, and households can access it. Electronic, it might use digital ledger technology, but it doesn't have to. There's a debate about that going on. A national currency denominated, meaning a pound of digital sterling would be equivalent to a pound of cash or a pound of bank deposit. Issued only through spending or against eligible assets, which are government bonds. And that's where this paper, as I said, differs. How can it be issued? And we'll talk more about that. And interest bearing, there is often a concern with the central bank issuing money because that has in the past been associated with inflation. And if what the central bank issues is cash, which has a fixed nominal interest rate of 0, and if it issues too much of it, then the only price that can equate demand and supply is the general price level, and you could indeed get inflation. But if you have an interest-bearing CBDC, it is the interest rate on CBDC that can adjust to equate demand and supply with no necessary first-order effects on the price level. And then that interest rate, as we will argue, can be used as a second tool of monetary policy, in addition to the interest rate that we already read about every week in the newspaper. And finally, coexisting with the existing present banking system. And that's where this differs from my much earlier work on the Chicago Plan, which is basically about narrow banking, and that would change what banks themselves do. CBDC does not change what banks themselves do. It just puts alongside the banks publicly issued currency. That's an important distinction, but otherwise it shares some features with that earlier work. So what are banks? I need to spend some time on that, because if you want to think about what happens when you introduce CBDC into an economy, you need to first of all ask you, where's that rubber going to hit the road? And where is it going to compete with other forms of money that are already out there? And our prior is that for developed economies, not so much for emerging markets, but for developed economies, cash is not a significant item. And the competitor, if you will, would be bank deposits. So if you want to understand how the two would interact in a dynamic setting, like in our model, you need to understand what banks are and how they function. And there I come to my earlier paper. Banks are not intermediaries of loanable funds. There were these beautiful quotes from a number of economists especially the one in Samuel's short talk, and especially the one from Bofinger, it was quite good. It is actually almost taken from my paper where we argue the Ptolemaic system of astronomy versus the modern system of astronomy. That's loanable funds versus the way actually banks work. That analogy came from that paper. And so what is the issue? The loanable funds model, and I call it ILF here for brevity, intermediation of loanable funds, ILF. Basically what that model assumes is that banks are intermediaries that take something in and then lend it out. It is basically that intermediation amounts to the trading of physical resources, which I will, in a logical sense, prove to you on the following slides. So what it amounts to is that banks collect deposit of commodities or capital from a saver and then lend those existing commodities to another agent, the borrower. It's a barter economy. It's of course complete nonsense because this is not what banks do. The financing through money creation, FMC model, it tries to map the actual credit process. Financing is the digital creation of monetary purchasing power, where banks make a loan of money to agent X, not of commodities, and credit that new money to the deposit account of the same agent X, meaning the bank creates both an asset and a liability side item, and the liability is the money. So let's talk a little more about that. Here it is in cartoon form. The loanable funds model at the top, you will see this a lot, including in academic publications, not necessarily with this imagery, but in general. Bank on the right-hand side has deposits, that's its liability side. On the left-hand side is loans. A saver needs to deposit something real, as I will now show. The financing through money creation model, there is no saver. The investor gets both the loan and the deposit and then uses the deposit in order to trade or buy stuff. Now, why are deposits in an ILF model not financial transactions? All financial transactions are basically variants of a check or cash deposit. And cash deposits are not that important, so let's stick with check deposit. They're variants thereof, they're much more sophisticated often, but it all amounts to the same thing. When a financial balance gets moved around, we can think of that for simplicity as somebody depositing a check. So household A and B, households A and B bank with banks A and B. A has done work for B, B writes a check to A, and A goes to his bank A and deposits the check there. Now, this does not mean that the banking system or even bank A has new money to lend. Because this check that A deposits in his bank only has value because the deposit already exists in bank B. Because if not, then B would have written a bad check that's not covered. So he's written a check that's covered, and that means what this check deposit does, it moves an existing deposit from bank B to bank A. It does not create a new one for the banking system as a whole. This will then be settled either through a transfer of reserves between the banks, or even there might be a loan balance remaining between the two. In which case, what bank A basically acquires is a central bank balance, is its reserves that it has gotten from bank B, reserves in the central bank. But that's not loanable funds either, because central bank reserves cannot be lent because only financial institutions have accounts at the central bank, right? It cannot be lent to non-banks. It only can be lent between banks. So there's nothing for either bank A or bank B to lend when a check is deposited or when any other financial transfer is made. So that means that in a loanable funds model, deposits and such transactions do not represent financial transactions. Because in a loanable funds model, the assumption is that somebody deposits something in the banking system, and the banking system then has more to lend. That is not the case. And the only way in which this could make sense is if A were to literally deposit physical resources that B has given him, and bank A can then lend out the physical resources. The banks would therefore be warehouses, and our economy would not be where it is today if that's how our financial system works. It clearly doesn't. Now, FMC, financing through money creation, their deposits are financial transactions. So the borrower simultaneously receives a new loan and a new deposit. The deposits can only increase through new loans, not through saving. They can also increase through a few other things, most importantly, securities purchases, but new loans are the most important. Now, these ledger additions involve no intermediation on the part of the bank. The loan is the right of the bank to receive future installments from X to repay the loan. And the deposit represents an obligation on the part of the bank to deliver current funds to X. Now, once you have a banking license, that obligation to deliver current funds is declared to be current funds, is declared to be money. And so therefore, the bank has created money, and that is because everybody accepts that this can be used as money. The central bank and the regulatory apparatus support this so that we can have an efficient medium of exchange. But somebody who doesn't have a banking license cannot do this, okay? Now, what constrains spending in the real world? It's, as I said, it's not savings. Savings is a real concept from the national account, which says that I get some real income because I've produced, say, some wheat in the fields, and I don't eat all the wheat and I save some of it. Okay, that does not create deposits. So what constrains spending in the real world is not just my income that I get in my budget constraint, but it's income plus new deposits. So I can supplement my income by getting a new deposit if I get a new loan, right? If I get a new loan, I get a new deposit, I have more money to spend. Now, in the future, I'm going to have to repay it. That's fine. But my purchasing power today depends on that, on the sum of income and new deposits. Now, these deposits are not a transfer of physical resources. They're in addition to the stock of purely digital purchasing power that will, however, be accepted in exchange for real goods and services. The ex-nihilo creation is completely independent of physical resources. Completely, it's not quite right. I mean, if you want to borrow from a bank, in many cases, the bank is going to ask for collateral, and that collateral is physical, but that collateral is never actually lent out or transferred or anything. It just sits in the background just in case something goes wrong with your loan. And otherwise, it's never touched, okay? Now, these banks, if you model them according to loanable funds and financing through money creation, you get very different behavior. And that's what matters when you think about the introduction of CBDC. In the loanable funds model, deposits literally come from a physical process of saving resources. They depend on how much you like to vary your consumption and your labor effort from one period to the next. This is by nature a slow and continuous process. It cannot jump around a lot. In financing through money creation, deposits are created on a computer as book entries. That can be instantaneous, discontinuous, and what constrains it is not savings. It's also not the quantity of central bank reserves. It is only the optimality calculus of banks and borrowers. Will I make a profit if I do this? And the borrower, same thing. Will I make a profit? Will I gain convenience? Will I be able to enjoy what I want to enjoy this year? That is the calculus that is made, and then these gross positions are created and entered. And so that's banking. Now let's briefly go over the literature. I noticed on your landing page for this event, this was mentioned that there was a tension in the literature, so I thought I also point this out. There is part of the literature that says that CBDC can lead to bank disintermediation. I distinguish disintermediation from runs, bank runs and bank disintermediation. Runs is something sudden. Disintermediation is something that can happen gradually over time, but your balance sheet will be permanently looking different. Now, the mechanism for crowding out of deposits in these papers that you will find is based on a loanable funds view of banking. And as we just discussed, that's not how banks operate. But why is this? So these models think of deposits and CBDC as two different investments of physical saving. And physical saving, as I said, has a limited elasticity. People are not willing to vary their saving that much from period to period, because they don't like to consume a lot more this quarter than last quarter, or work a lot more this quarter than last quarter, only in exceptional circumstances, etc. So if deposits and CBDC are both claims on this stock of physical saving, then if CBDC takes a larger share, then deposits must take a smaller share. That is, in very abstract general terms, what this literature has in mind when it thinks about bank disintermediation. But deposits are not created through physical saving. They are gross financial ledger entries. They can be created or destroyed very elastically by banks. And the determinants are these demands for gross deposits and gross loans, both by banks and households. The consequence, and then we will also see this in this paper, is that disintermediation is much less significant or disappears, because it has nothing to do with saving. It has something to do with when people hold CBDC as money, do they want more bank deposits or less? And there's good reasons to think that they might want more. We will talk about that. Now, bank runs, this can happen overnight. And in the literature, you find two different types of bank run. One is balance sheet runs, very well-known paper by Brunnermeier and Niepelt. The run there is a check withdrawal of gross financial balances to another bank, from bank A to bank B. Now, this requires settlement. So it replaces the deposit that is lost with an interbank liability. It might also just change the amount of central bank reserves, but it could also lead to an interbank liability. In the first instance, before settlement, it is actually an interbank liability. Now, in Brunnermeier, and of course, as long as banks are not, as no bank is a complete basket case that nobody wants to lend to, this will happen without any problem. Now, in Brunnermeier and Niepelt, not only other banks, but also the central bank will accept a check that is written from somebody who wants to run from some bank. Now, that means that you could not just have runs from one set of the banking system to another set of the banking system, but also runs from the entire banking system to the central bank. And that is why we have argued in the paper with Claire Noon that the central bank should not accept this check and only accept government bonds. Or actually, it's a little more nuanced than that. We say that the central bank might accept this check during most times, but it would never unconditionally commit to doing so, no matter what happens, because if it's a conditional commitment and if things get really sticky out there, then the central bank could close that door and thereby prevent a run from the entire commercial banking system to the central bank. If that is the case, then runs into CBDC are not bank runs at all. They're runs into CBDC from government bonds, and bank deposits are not touched by this. And that's why we made that proposal. There are other proposals out there that are advanced by several central banks, which is to have account limits, either direct quantity limits or price limit, where beyond a certain CBDC balance, you get a very bad interest rate that is going to discourage you from doing that. I have no time to talk about this, but I have problems with that idea and the practicality of that idea. Now, the other idea of bank run that is out there in the literature is the famous paper by Diamond and Dipvig, and I call those all-you-can-eat runs, which are very strangely popular in the literature because it's a cute model, but it's literally an all-you-can-eat run because there's no settlement, no check is withdrawn. What is withdrawn is somebody comes to the bank and say, I'm in a panic now, I want my chicken. And it's literally a chicken. It's something physical. It's not a check. You're not running and withdrawing a check from one bank to another. So the bank has to supply physical resources. And in our model, households simply cannot withdraw physical resources from banks, and that's also true in the real world. I think this model makes no sense whatsoever, and therefore I'm not going to spend time on it. Now, a little bit more on that paper with Claire Noon, because it is relevant to several of the things on the landing page about how secure would a CBDC system be. The proposal is the central bank only guarantees issue of CBDC against eligible securities. That is, by the way, the same as with cash and reserves today. It's explicit for many central banks that if they want to obtain cash, if commercial banks want to obtain cash from the central bank, they have to purchase it. And they can only purchase it with eligible assets, which are government securities. The exact institutional arrangements differ from country to country. And we argue that that should continue with CBDC. The central bank should never guarantee to issue CBDC against bank deposits because it would open the door to aggregate bank runs. The guarantee would. If the central bank does it in 99.9% of the days, then that's another matter. That's its own choice, but it shouldn't unconditionally commit to it. In that case, a bank deposits to CBDC run becomes very hard in aggregate. First, it's not a run from deposits because non-banks can only buy CBDC against deposits from other banks, from other non-banks. So if I want CBDC, if I want to run to CBDC in this world, I cannot get more from the central bank, but I can get something from my neighbor if he's willing to make the trade, and that means I'm going to end up with his deposit and he with my CBDC. That's irrelevant for the aggregate stock of deposits, and therefore the bank is not under threat. CBDC policy rules can further discourage volatility in CBDC demand. If you have a quantity rule saying, you know, I'm going to issue 1 billion come hell or high water, then the CBDC interest rate is going to have to clear the market so that demand is equal to supply. We're assuming there that the interest rate, there's an efficient interest rate adjustment mechanism. Now, if there is a run into CBDC that would then, an attempted run, it would then make that interest rate very low, potentially negative. And at that point, you might not or want to continue with an interest rate rule because you don't want to pay minus 10%, and you stop at minus 2%, let's say, and then you would have an interest rate rule. At that point, the CBDC supply becomes endogenous. The quantity clears the market. That's only a problem if people want so much CBDC that they run out of government bonds. Now, given the trends that we see out there in government indebtedness, that would be one hell of a shock because there's a lot of government debt out there. But if that was the case, you could switch to other securities and declare them to be eligible assets if you want to, right? So that's the proposal. Now that's going to be incorporated into a model, and I'll just give you a very brief overview. I apologize, I use a little bit of notation because some stories just can't be told without it, at least not in my mind, but it's very little. So this is a model that has two symmetric countries. We think of it as the US and the rest of the world, but you could, could be anything. It's generic. There's a real sector where output is produced using capital and work. And that's standard. And then there's I should have had another bullet here. The financial sector is is basically the FMC model. Monetary policy has a Taylor rule. The Taylor rule is the well-known policy rule for the interest rate on central bank reserves. That is the main, in many cases, exclusive tool of central banks for the management of the business cycle. That's the interest rate on central bank reserves. Reserves are the assets that only commercial banks can hold at the central bank. Right? Now, in our world, this would be augmented with the CBDC rule. And fiscal policy, you need a deficit rule because it's going to become more difficult to separate monetary and fiscal policy when you have CBDC, which generates big positive and negative seigniorage flows. Seigniorage is the revenue from money creation. Okay. So here is the model in a nutshell. The arrows, except for the one single arrow, can you see when I move my mouse?
Yes.
Yeah. Except this goods trade, every other arrow here is a financial arrow. So on the left, you have the home country, on the right, the foreign country. We have households in the middle, banks at the top, central bank at the bottom. The fact that banks create deposits through loans is visible here because lending and deposits go in opposite direction between households and banks. That also happens across borders because these households bank with both domestic and foreign banks because they need domestic and foreign currency. We have a proper modeling of interbank nostro and vostro accounts, which are necessary to settle cross-border banking transactions. They are part of the model. And then we have CBDC holdings, which can be both domestic and foreign in this model. Okay. Now, the building blocks for banks. They have a net worth and are subject to capital adequacy regulation. So they choose their assets and liabilities to maximize that net worth, and they suffer a penalty if their net worth or equity drops too low, and that's a regulatory penalty. There's the Basel rules out there on capital adequacy. That's what this is meant to capture. Loans, we have retail lending banks that need their own capital to protect themselves against loan losses. And they also need, on the loans that they do make, they also need collateral from their borrowers. The loan collateral is a portion of the borrower's capital stock. All of that, I'm a former banker. You didn't mention this in the beginning, Samuel. I worked for Barclays Bank for 5 years. And this whole model of banking to me is it's of course highly abstract, but it's quite a reasonable representation of what banks do. Deposits, retail deposit banks with market power. So usually in the literature, money is thought of as just cash, which, as I mentioned, in developed economies is nowadays a sideshow, especially in Sweden, if I understand this correctly. Here in our model, money is bank deposits and CBDC, and you need bank deposits and CBDC in order to be able to buy goods for consumption, goods for investment, in order to pay your workers, in order to pay the suppliers of your capital. That's what banks do with their deposits. CBDC, there's a few, and this is just very high level. What's our CBDC like? Well, it's a retail variety of CBDC. Everybody can hold it. It competes with bank deposits as money. It is accessible from abroad, just like bank deposits. It is interest-bearing and separate from reserves. So reserves and CBDC are separate items on the central bank balance sheet that pay a different interest rate. And CBDC is issued against government bonds, not against bank deposits, as I already mentioned. Households, our households are both the productive firms and literally the households like you and I. And so output is produced using capital and labor. Goods prices adjust slowly over time, as they do in these models and in the real world. The households have preferences over consumption and over the hours they work. And as I mentioned at the beginning, they like to smooth that. They don't like that to jump around too much. Their consumption, in turn, consists of home and foreign goods. They also accumulate capital, and that's subject to adjustment cost. Both consumption and investment require money balances. And what is money? It's a combination of, first of all, home and foreign currency. And for both home and foreign currency, in each currency in turn consists of deposits and CBDC. And we model that as imperfect substitutes, meaning that, if the interest rate on both deposits and CBDC is 2 and the bank raises its interest rate to 2.01, then if there were a perfect substitute, everybody would want to hold bank deposits and nobody CBDC. That's not what happens in the real world. It's not likely to happen in the real world because there's evidence on what happens when an individual bank raises its deposit rate and its competitors do not. And in terms of what happens to deposits at that bank, the effect is surprisingly small. So we're assuming that it's going to be bigger with CBDC, but not really, really big. The household budget constraint is very stylized. So the budget constraint is when you balance your books, right? You balance your books and say, okay, this is how much income I made, this is how much I spent, and that's what's left over, and I'm going to invest that in the following assets, okay? So the assets into which I invest that is listed here on the left-hand side in symbolic form. So again, apologies, I need a few symbols. And so D stands for deposits, L stands for loan, H, lowercase h is household, and uppercase H is home currency. Okay, so those first two items is deposits minus loans. So what that means is that I, as a household, can accumulate deposits, and it is independent of what happens on the right-hand side of my budget constraint, how much I earned, how much I spent. If I just increase my loans by £1,000, then I can increase my deposits by £1,000. And for households as a whole, that's what will happen. Even if it's not the same household, but if one household increases his loans by £1,000, then either that same household or some other household is going to have their deposits increased by £1,000. And this is an aggregative model, so I only care about what's happening to households as a whole, right? So this is, in symbolic form, modeling the gross asset and liability creation by the banking system rather than the intermediation of saving. You have the same thing going on with the banks, but I didn't show you that in terms of symbols. Okay, and now fiscal policy. This is where a lot of the action happens, and this is a so-called government budget constraint. Apologies for all the colors, but I needed to somehow make it visually distinct. So what you have here, again, on the right-hand side, that's what the government pays on its liabilities, including CBDC, plus government spending here, minus tax revenue here, right? M plus B is CBDC plus government debt, okay? This is taxes, this is spending. Now, few issues. First, no deposits enter here. So that means the government does not unconditionally commit to be a market maker between CBDC and deposits, meaning it will not, this is a consolidated government, including the central bank. It does not say, look, if you want to come to the central bank to a window with your checkbook and write a check for £1,000, I'll give you £1,000 worth of CBDC. Central bank doesn't do that, right? And that's why you don't find deposits here. That's the point one. Point two, the interest rate IM here is much lower than IB. IM is the interest rate on CBDC is much cheaper because CBDC is money. And if you look at the typical interest rate of a checking account, not in recent times, but except very recent times, not in recent times, but going further back, checking accounts typically pay much less interest than wholesale time deposits and stuff like that. That's because people value the convenience of having a checking account and being able to make payments with that. And that's likely to happen with CBDC too. And so the government gets cheap financing through CBDC. That's an important point. Thirdly, the interest rate on government debt itself is also likely to decrease. That's a little more subtle, but if I issue CBDC here and I only issue it through government against government debt, that means M goes up and B goes down. B is defaultable debt, M is money, and it's not defaultable. You cannot go to the central bank and say, here's my CBDC, repay me, because the central bank is just going to give you more CBDC. It's a final settlement medium. You cannot ask for anything else, right? And therefore, it's not defaultable. You cannot possibly default on money. But you can default on debt. So if the issuance of a large stock of CBDC brings down B, that means the government's risk of default should decrease, and that's incorporated in the model. And so this IB also declines when you issue a big stock of CBDC. Then we have a fiscal rule here in the background, but let me not spend time on that, but that stabilizes the stock of debt. Monetary policy. This is the policy rate on reserves, again in symbols. I is the rate that you read about in the newspapers all the time. I bar is the rate that would be there if there were no shocks to the economy, and pi is inflation, expected inflation divided by some inflation target. And so what this tells you is that when inflation is high, and this is a coefficient that's greater than 1, if inflation is high, central bank is going to raise the interest rate, right? Which also makes the real interest rate increase, and that's what central banks do, right? It stabilizes inflation, and that's very standard. So although CBDC is new, many things remain unchanged, including this standard monetary policy rule. I've left a few minor terms out here, but I wanted to make it simple and not have too many symbols floating around. Now, CBDC. We are going to think about various different rules for CBDC. And basically, if you ask where do these come from, they come from our superior insight and our superior economic intuition, joking. We just basically said, you know, as economists, we think that a rule should look such and such, and let's write it down, and then let's try to play with it and see what it does. Because at this point, that's the only thing we can do, because nobody has issued a CBDC yet except the Bahamas. And so basically, you're going to have to use a model as a laboratory to think about how this would work. And what we do is, in fact, to write down rules that we think make sense, and then say which makes the most sense. And in fact, we find that this one here makes the most sense. More on that later. But then these terms over here have a negative coefficient attached to it. Okay, so what that means is that if inflation is high, or in this case, it's credit relative to steady state credit, if inflation is high or credit is high, I'm going to lower the interest rate on CBDC. What does that do? Like, it makes CBDC less attractive. Then there is less CBDC. People want to hold less CBDC. That reduces money, and that reduces output, and that reduces inflation. That's the idea here. So basically, when there's lots of credit or lots of inflation, the economy is overheating. I want to take the heat out of the economy. With the policy rate, I do that by raising the rate. With an interest rate on money, I do it by lowering it. So a lower interest rate on money is contractionary, not expansionary. You need to reverse the usual logic that you get when you think about interest rate. Particularly because in the context of CBDC, many people have been talking about, oh, this would give us a nice way of getting around the zero bound on nominal interest rate with CBDC. If CBDC replaces cash, which, by the way, Bank of England doesn't advocate that. I don't advocate that, not even close. But if you were to think in those terms, would that even make sense? No, it wouldn't make sense, because if you lower the interest rate on CBDC below some zero lower bound, you would do the opposite of what you intend. Okay, so that's important. We're also going to think about a cash-like CBDC, where the interest rate is, gross interest rate is simply equal to 1, meaning the net interest rate is equal to 0. And also we're going to think about a quantity rule, which has similar terms to up here, but what we're putting on the left-hand side here is the CBDC to GDP ratio, the stock of CBDC, but then a similar rule. There's other rules in the paper. It's quite a comprehensive paper. I don't have time to talk about all of them. So then we go quantitative. This needs to be a credible exercise that people can believe. So we use 3 decades worth of US quarterly data. We calibrate the parameters that govern the steady state of the economy, the resting state when there's no shocks, no volatility. And we estimate the parameters that govern the dynamics when there are shocks. And the calibration is standard for the real sector, very detailed for the financial sector. Normally, I show some balance sheet and stuff here, but I don't have time. But it's very, very carefully done for the financial system, and we have quite some confidence in what we have done there for the steady state. Then we go to estimation. We use Bayesian techniques. So this is sort of state-of-the-art macro, where there's a bunch of shocks in the model, which I also didn't emphasize when I presented it. We're going to estimate what those shocks were by running the model and estimating it using some observable US data on both the financial and the real sector. And we find some well-behaved estimates. The only thing I want to show in that context, and only in words, is the decomposition of the variance of various macroeconomic variables than we know, like real variables like GDP and consumption and investment, and financial variables like credit and spreads and exchange rates. And so we find that financial shocks account for around half the variance of real variables and also inflation. That's a lot. So this model is very strongly suggesting that the financial sector is not something that you can just detach from the real sector. It's not a veil. It actually interacts very directly with the real economy. And when the banks don't lend, the machines don't run, kind of thing. And they do explain the bulk of the variance of financial variables, okay? And this is important because what we will find is that CBDC responds most effectively to financial shocks, not to real shocks, not to shocks to my consumption preferences or to my productivity, but to shocks to banks' credit provision or demand for the dollar, things like that. So I'm now going to show you the first experiment with this rigorously quantified model. We'll be showing a transition to CBDC. So this is an economy where until this evening, there was no CBDC in the economy, and tomorrow morning, the central bank is going to issue CBDC worth 30% of GDP. That's, of course, totally unrealistic. No central bank is going to do that. It's going to do it more gradually. But in the model, it's nicer to do it this way because you get very clean effects that are easier to interpret. And in the long run, it makes no difference. In the short run, it does, right? So we get expansionary effects. I have them here in words, but I think in order to save time, I'm going to show you just in the graph. Now, this graph, I'm going to have to be going very carefully because I don't think it's that visible. But what I show on the horizontal axis in each case is 100 quarters, which means 25 years. There's a shock that hits here where there's a zero that you can barely see. That's where a shock hits, where CBDC goes from 0 to 30% of GDP, and government debt goes from 80 or 75 to 45% of GDP. This is the issuance of CBDC against government debt. So what this does is it lowers, and by the way, the transitions are shown here. This is the model simulating a transition. In blue, you see the actual transition. In red, you see where the economy goes in the very, very long run, which takes quite a long time to be reached here. It's not nearly complete even after 25 years, because this really affects things like the capital stock of the economy. It takes some time. So you can see that in the long run, real interest rates decline here by quite a few basis points. Like a half a percentage point or something like that in the long run. In the short run, it doesn't. It actually has to increase, and that's because the policy rate, the one that we already have in the economy today, responds to inflation, and inflation goes up when the economy booms, and the economy booms when there's reasons to consume and to invest. Now, why are there reasons to consume and to invest? Well, first of all, there are lower tax rates. The government benefits from immediately lower interest rates on CBDC, and then over time also lower interest rate on the rest of government debt. And that allows it in the budget to reduce taxes on saving, taxes on work, taxes on consumption. All of these taxes reduce disincentives, like, for example, the incentive to work, etc. That makes, you know, people invest and work, etc., etc. Also, there's something called the money tax rate, what I call the money tax rate, that also declines. This is basically a monetary friction that is similar to a fiscal tax rate, and that is because in the economy without CBDC, the economy has quite a lot of frictions to overcome for the banks to create its money. This doesn't stop when you introduce CBDC, but it becomes less severe because CBDC can be produced relatively cheaply by the central bank, which means that this friction also decreases. The combination of those things mean that output increases by 2% in the short run and by almost 6% in the very long run. And we also compute something called welfare. Welfare is basically how much would it be worth to people in terms of their steady state consumption, the consumption that they get on average today. How much of that consumption, of that today's consumption, would it be worth to them to live in this new world with CBDC? And we find that that's about 2% of consumption. In this literature, that's an enormously large number. And, you know, it's based on very rigorous quantitative work. Prove us wrong. If you don't believe it, prove us wrong. And you'll have some work to do. Now, banks, we see loans and deposits here. These are the banks that are competing with this newly issued CBDC. You see in the short run, a bank balance sheet decrease a little bit, but then in the long run, they increase tremendously by over 15% of GDP. This short run is because we're assuming an overnight introduction of CBDC. If this was not overnight, this short run decrease would be much smaller, or it wouldn't even happen at all. And then in the long run, you get a big expansion in the balance sheet of the banks. Now, it is true that the banks will have more wholesale funding and less retail funding, because some of their retail funding will be crowded out by CBDC. But it naturally flows back to them in the form of wholesale funding. And this could mean, if nothing else changed, that borrowing would become more expensive. But because the amount of government debt and therefore the risk of the government defaulting decreases so much, overall interest rates on everything decrease. We see that over here, right? And that means the average cost of funding of banks in the long run actually remains almost the same as before the introduction of CBDC. So this model at least suggests that the introduction of CBDC is not harmful to banks, especially if you don't do it overnight. And this is assuming a comparatively high substitutability between bank deposits and CBDC, which militates against banks. So we're actually being conservative here, because if we were to use the substitutability that comes out of the empirical literature on banks competing with each other, this effect would be much, much more beneficial to the banks. Now we talk about optimized simple rules. So the policy problem is, you know, many central banks may issue CBDC, not always for macro reasons. And the question is, how should CBDC policy be conducted at the macro level? Because even if you don't issue it mostly for macro reasons, but say for efficiency reasons, you're still going to have to do macro policy here. And what rule are you going to use? And as I said earlier, we specify a number of different possible rules and then evaluate them. The valuation computes welfare. I already explained what welfare is how much consumption is it worth to me to live in this world with these different policy rules. We're basically going to be doing grid searches over these policy rules to calibrate them with different strengths of responses to inflation, to credit, et cetera, and approximate what welfare would be. This is the most technical part of the paper. You don't need to concern yourself with the technical part because you can just look at the pretty pictures. So, and this is the first pretty picture, and this is basically an economy without CBDC, where you have the inflation response of the policy rate on this axis, the output response on that axis, and the welfare gain on the vertical axis. And it comes to about 0.5. So responding more aggressively to inflation raises welfare quite a lot. Output doesn't make that much difference. This is a very standard result that you find all over the economics literature. Now let's go to a CBDC world. Now what we're showing is, again, the policy rates coefficient with respect to inflation, but now the CBDC interest rates response to credit, not to inflation, to credit. And we see that there's a big increase in this welfare, both in the direction of inflation and in the direction of credit. In fact, credit accounts for around just under half of the total gain, and the total welfare gain is 1%, which is a very large number in this literature. It's not outrageous, but it's quite large. And this is our best rule. So it's basically an interest rate rule for central bank reserves and another interest rate rule for CBDC, but that interest rate rule responds to credit, not to inflation. Okay, now we're also looking at a quantity rule instead of an interest rate rule with a credit gap, and we find that now in the direction of credit, there is not much gain. So quantity rules are worse than interest rate rules. For those of you who have studied monetary economics, this will sound very familiar. And this is because of an old paper by Poole when monetarism was being debated. It was found that quantity rules are worse than interest rate rules when there are shocks to the demand for money that are prominent. Because if households want more money per unit of output, and you don't give them the money, then they're instead going to reduce the output. And that is going to be bad for the real economy. Something similar is at work here. Because all our financial shocks are in some way shocks to excess money demand. And so therefore, if you fix the interest rate, it's better than fixing the quantity, because then households can flexibly adjust their money quantity to what they need. And that then also allows the central bank to set a more aggressive interest rate rule. Let's look at a little example. A home credit supply shocks. The banks are lending less. If they lend less, they create less money, and that lowers GDP. And what we're going to show here is that a counter-cyclical CBDC response to credit can eliminate this drop in money. So this is, again, an impulse response. In this case, on the horizontal axis, you see 40 quarters or 10 years. This is a more transitory thing, although the shock is still very long-lived. That's how we estimated it. And so what we see is that the red one is the quantity rule. The black one is the interest rate rule. Forget about the others. It's not relevant for what I want to show you. And so the interest rate rule raises the CBDC rate much more aggressively. And the quantity of CBDC as a consequence also increases much more aggressively. What that means is that the quantity of money doesn't drop by as much because the central bank makes up for the lack of money created by the banking system by pushing out more CBDC. And if you look at here at GDP, it is much more effectively stabilized in the black line, the interest rate rule, than the red line, which is the quantity rule. I have one other impulse response to show, but I think I'm running out of time. Unless you give me extra time, Samuel, that's up to you.
No problem. You can continue a little bit more.
Okay, good. So This is a global run into home CBDC. So this is, some central bankers have experienced concerns with that. What if I issue a CBDC and suddenly everybody and their mother comes from the rest of the world and wants my CBDC? Is that not going to really destabilize my financial system, right? So basically what happens is this. Again, the black line is an interest rate rule. The red line is a quantity rule. Again, forget about the others. They're very similar anyway. But basically what happens is the shock, you will see it here. People want less deposits, right? Ideally, and more CBDC, right? There's CBDC that wants to go up and deposits want to go down because that's the shock. And that's not just households, but everybody in the whole world is assumed here, right? So it's a big shock. Now, under the interest rate rule, the central bank just says, okay, and as long as you have enough eligible assets to give me, and the shock is very large here, but despite that, it's small relative to the outstanding quantity of government debt. Basically, everybody gets their CBDC and reduces their retail deposits. But this flows back to the banking system as wholesale deposits, because and this is basically, this is a shuffling around of gross positions. The system can never lose the deposits. It's just a different holder. And the reason why this happens is that in this model, there's somebody called a financial investor who alone hold the portfolio of government securities. When households suddenly want more deposit, more CBDC, they can only get it via the financial investors. The financial investors go to the central bank, give it the bonds, central bank gives it the CBDC, then the financial investors trade with the households, the retail investors, and they give the CBDC to households, and the households give their deposits in turn. Then the financial investors are going to be holding basically a check drawn on the bank for a deposit, but they're not going to want to hold retail deposits, they want wholesale deposits. So what happens here is that the banks would then rely more on wholesale deposits, but it's not that deposits run away. It's actually impossible because this is just an exchange of gross positions between different participants in the financial system. And this does affect the average funding cost of the bank, but it's not per se a financial stability problem. And if the central bank does this, then you get that GDP only decreases very, very little. There's a small effect on GDP. It has something to do with the way monetary frictions evolve, but it's very, very small. If, on the other hand, you pursue a quantity rule, people want CBDC, but they can't get it. Instead, the interest rate on CBDC declines because people want so much. So CBDC issuer can get away with paying a much lower interest rate. But in that case, the decline in CBDC is much larger. So this is another reason for saying, if you have these portfolio shifts, another reason for saying you want an interest rate rule, not a quantity rule. Okay, inflation gap instead of credit gap. Again, a big increase in welfare in the direction of inflation. But if the CBDC rule also pursues inflation, there is almost no gain. And this is because the response of inflation tends to be far more short-lived than the response of credit and the real economy. And therefore, you're already responding to inflation with the policy rate, but with the CBDC rate, you want to respond to something more long-lived that affects the real economy via the financial system, and that is credit. So this rule isn't good either, in comparative terms. Cash-like CBDC, you just fix the nominal interest rate at 0. You see the number here is very small. It's 0.39, 0.4. Remember, the best one we had was over 1%. So this rule isn't good in welfare terms. And this is both because you now have no countercyclical tool that you can use with your CBDC interest rate because you switch that off by saying the interest rate is 0. And secondly, if there's any inflation in the economy and you pay a zero interest rate, then your real interest rate would be negative, so that CBDC becomes a very unattractive investment. Okay, as a cash-like CBDC, then I'm almost ready now for the conclusion. This is an interest rate rule with a credit gap, just like before, but now automatic fiscal stabilizers. Automatic fiscal stabilizers basically saying, if the economy is in a recession, then in this particular instance, the government is going to print up checks for people and distribute them so that they have more to spend. Okay. Normally, in an economic model, that doesn't make much difference if it's literally just checks that are printed out. But here, it turns out that almost the entire financing of this check printing takes the form of CBDC optimally. So the automatic stabilizers actually pump more money into the economy through a fiscal channel that stimulates output, and that is basically reminiscent of Friedman's famous 1948 paper, where he claims that the most bang for your buck stabilization program on the part of a government should be money financed, not financial, money financed fiscal deficit. The money in this case being CBDC. Money financed fiscal deficits give you an extra boost in stimulating the economy. 1.58 is the number here, so you go get another more than 50% gain. So that's it for the rules. So the summary, we found for taking the stock of CBDC from 0 to 30%, we get output gains in the long run of just under 6% and welfare gains of 2%, bank balance sheets that grow in the long run, and bank average funding costs that remain roughly constant. For optimized simple rules, we found that the central bank should run an interest rate rule that responds to credit and the state of the financial system. Among the ones that we tested, and it's quite a few, that one was by some distance the best, except for the one that also has fiscal policy. Lower welfare is obtained with quantity rules, responding to inflation, something called reserves rules, which I didn't talk about, and a cash-like zero interest CBDC, and even higher welfare under CBDC financed automatic fiscal stabilizers. Open economy, didn't get to talk about that during the rest of the presentation. Originally, this paper was about the open economy, and there's still a good part of it, still is. So we find that CBDC policies, if done optimally, can reduce exchange rate volatility by around a third, capital flow volatility by around a third. And as we saw in that second policy experiment that we saw, even large shocks to CBDC demand have a small real effects if they're flexibly accommodated by the central bank. Effects on banks. Again, I added this slide because you put some emphasis on that in the landing page. Disintermediation, no, it's not our conclusion. Deposits are likely to grow strongly in the long run. It's true that the deposit composition would shift a little bit from retail to wholesale, but the average funding cost would remain almost unchanged. Bank runs, the risk would be minimized through the issuance arrangements that we proposed. The alternative proposal out there and currently dominant is to have these tiered reward structures for holding CBDC. That is trying to address the same thing. CBDC issuance would then only be guaranteed against government securities, not against bank deposits. Central bank could still allow issuance against bank deposit during normal times, but it would never unconditionally guarantee it under our scheme. That is not what the ECB and the Bank of England are currently thinking about. But I'd like to keep this in the debate. And that's it. Thank you very much.
Thank you very much. Super interesting presentation. Some short questions here. Why did you become interested in this subject about money and banking? What motivates you?
Money and banking. Well, that goes a long way back. I was very concerned starting about 2005, 2006 that there was a financial crisis building up. As a former banker, I read about all the things that were problematic in the financial sector in the United States at that time. So I was very, very interested. I read a lot about monetary history, history of monetary thought at that time, and especially once the crisis had actually happened. And that's what then led to my Chicago Plan paper that I wrote a number of years after the crisis. When I interviewed at the Bank of England, this was Andy Haldane at the time. He knew about the Chicago Plan and was already at that early stage interested in central bank digital currency. At that time, I immediately saw that many of the principles behind modeling and thinking about full reserve banking and central bank digital currency are similar, although some are different. I had spent a lot of time on the Chicago Plan paper, and I'm going to be working on a revision of yet another revision of that later this year. So the groundwork had been done to write a paper on CBDC. So that's how I got interested in that. And then, it became clearer and clearer from looking at the academic literature that there was just no understanding of how banks operate. But that has been an immensely frustrating experience trying to get that accepted and try to present that in academia, because people are wedded to many people are wedded to this loanable funds idea. Although I have by now published some papers that use the financing through money creation model, but it should really be recognized that the loanable funds idea is wrong from start to finish. But that's for the long haul. I didn't think I would say that after so many years, but surprisingly, that is still for the long haul. That's it.
Yeah. Thank you. Just to make your results a little bit more concrete for people that are not into economics, what would output gains of 6% and welfare gains of over 2%, what would that mean in practice for ordinary people or for the society, if you just envision it?
Well, people always talk about economic growth, right? And so an output gain of 6% is like having another 0.5% of economic growth for 12 years in a row, right? Add that to your economic growth for 12 years in a row, another 0.5%. This is a significant number, and through a purely monetary reform. So that's what that means. I don't know. I mean, beyond putting it in terms of output growth instead of output levels, I don't know how else to answer that question. Is that good enough?
That was a good answer, I think. Yeah. Thank you. And another question here. You argue that we should introduce a CBDC in parallel with the existing system, and this would give monetary policy two tools then. The interest rate on reserves and the interest rate of CBDC. Just two questions about this. So you say that a contradictory effect is associated with the opposite changes in these two policy rates. A higher interest rate.
Contractionary.
Contractionary. I'm sorry about my bad pronunciation of words. I'm not super used to speaking English. So, but this is a little bit counterintuitive. We're used to, you put the interest rate down and then It's expansionary effect. Can you just explain this once more again? Just the causal mechanism here that caused this.
Yeah. So the basic idea is that when people have more money in their pocket, and their pocket being like very widely interpreted, including in their cell phone nowadays, when people have more money, readily available purchasing power, then they're more likely to spend. And that's the idea, you know. If you're awash in liquid funds that you can spend, you're more likely to spend. Right now, that money can come in this world in the form of bank deposits and CBDC. Now, if you keep all other interest rates the same, but you lower the interest rate on CBDC, then you make it very expensive to hold CBDC instead of some other asset, like some bond or something that pays you, let's say, gives you a good, healthy interest rate of 4%, but your CBDC pays now, let's say previously you paid 2%, and now you lower it to 0, right? Then you're losing 4% interest, okay? So what you're gonna do, not everybody, but at the margin, some people will say, no, that's too much. I lose too much by holding the CBDC. I'm going to hold less, right? And so instead, I'm going to, I can go to the central bank and trade it against the government bond, right? And the government bond is going to pay me my 4% again. But then I have less money in my pocket, and then I'm less likely to spend. That's the idea.
Thank you. Very good explanation. And one more question about this. This structure with two parallel systems, it can seem to be a little bit complicated. I mean, for ordinary citizens, it may be a benefit to be able to understand how things work. So there's an alternative would be to just collapse the structure into have only CBDC, just one type of money and nothing more. That may be better from a democratic perspective, from a transparency perspective. But you may argue here that the welfare gains, the output gains from having two systems would be worth the loss in transparency and understandability of the system. Or
no, I mean that's sort of going in the direction of the Chicago plan and narrow banking and stuff. That's just not on the table, right? The Chicago plan was a very interesting paper to write, and I think I can see interest in that growing again. But it was never on the table, right? And I also think that putting that on the table overnight would be quite risky, because you need to first of all see whether a system where the central bank issues a significant quantity of money works well, right? Because we have a banking system that, for all its faults, gives us an efficient payment system, right? And to replace that with something where you don't even know yet whether it's going to work, because there are things like basic things like technology and law and software and what have you, you don't know, right? So you can't just barge through the door from one day to the next and do something so completely new. And that's, of course, why that's not on the table. But CBDC is just something that supplements something that the banks are doing. There are many reasons why people say this is beneficial in addition to the ones that I have mentioned, such as financial inclusion in countries where people have trouble getting bank accounts, such as the ability to do stuff on the blockchain with a CBDC that runs on the blockchain that is not yet possible to do with bank deposits. I have heard all sorts of stories of how this could genuinely add value. Cross-border payments, which are very expensive to make and slow through the existing systems, could be much more efficient with CBDC. There are many reasons why this is already beneficial, but you don't want to put all your eggs in one basket overnight.
Thank you. One last question, and then we open up for the audience. So a question about bank runs here, and just to compare your solution with Dirk Niepelt's idea that the central bank can just automatically lend money to the banks, lend all the money they need without any collateral requirement. I understand Niepelt. Why no collateral requirements? Why? That's because so when you put money into your bank account, you don't require the bank to deliver collateral for you. For everything to be exactly the same for the banks, then the central bank has to also lend the corresponding amount to the banks without any collateral requirement. But you see Niepelt's proposal as a theoretical benchmark, as a proof that it is possible to introduce a CBDC without any changes at all for the banks. But you do not see it as a policy suggestion. And but in another paper, you write, what would truly be radical and highly undesirable is a guaranteed issuance against bank deposits, which would amount to a guarantee of automatic and if necessary, unsecured lending to the bank. So yeah, so you don't see it as politically desirable. Just a few more, then you can. So my question is just, why would Niepelt's proposal be radical here? Wouldn't it just make the implicit guarantees of the current system into explicit guarantees? Because Niepelt also he writes that the state of natures in which banks would not service their debts vis-a-vis the central bank would be the very states in which banks did not service their debts vis-a-vis depositors before the regime change. So just in other words, suppose that we implement Niepelt's proposal, and suppose that banks cannot repay their debt to the central bank. This would be equivalent with a scenario in the current system where the banks cannot repay their debt to the depositors, and where the insurance guarantee then force the state to pay anyway. So compared to the system we have today, there seems to be nothing radical or undesirable with Niepelt's proposal. Or am I wrong with this?
Yeah, I mean, when I first saw that paper presented by Brunemeyer, it was at the BIS, and I was in disbelief because it's one thing to write down an economic model, it's a little schizophrenic with that paper because they often say, oh, it's just a theoretical benchmark. They say that themselves. They say there's something called the Modigliani-Miller theorem in economics that says equivalence of debt and equity financing under certain highly abstract conditions that never hold in the real world. But that's a benchmark, and you could start building economic models off of that by saying what's different from that. And they said it that way, but then sometimes you read the way they present it and you read the last part, and it does look like a policy proposal. It does look like something that they want to be taken seriously. But then, the reason why I was in disbelief, think about what this means in the real world. Just think about that. You would have a situation where, for some reason, you have these banks in the US that are all in trouble, and suddenly everybody thinks, well, I think the whole banking system is in trouble. There may be nothing behind this. There may be no reason to do this, but they're all doing it and they're all running. And at that point, basically, there's a huge that this is the mother of all bank runs. You could call that in some nice theoretical thing, and that central bank does this on paper, but it's the mother of all bank runs. Everybody is running from the banks, and that would be terrible for the financial system. It would be terrible for the banks. It's something that you need to avoid at all costs. Why do you think people are so concerned when they talk about CBDC that they're talking about this alternative proposal of putting in all those tiered interest rate structures or account limits or what have you. That's because they're concerned about that. The banks would be in really deep trouble, and they would basically become an extended arm of the central bank. And it's not even clear, at what rate would the central bank fund this? Would this be at a retail rate or a wholesale rate? So the whole host of questions. The taxpayer would be responsible if the loan portfolio was indeed not sound, because then the central bank would be holding the liabilities of a bank whose assets are not worth as much as the liabilities. The taxpayer would be responsible for that. All of that is highly undesirable. You can manage it somehow, but I think what you should really manage is a system such that you never get to that point.
Okay, thank you. I will not have time for follow-up questions, even if I wanted to let the others of you in here. We have a few. Who is first? Do you know?
Yes, Jeff Eder, welcome.
I would just like to confirm my understanding of the process, at least in the macro sense. So the central bank could just add a row below banknotes in circulation on the liability side of its balance sheet. They could label it CBDC or digital currency, and then create the money by directly acquiring securities from the government. Additionally,
no, not from the government, from whoever acquires the CBDC. So probably this would, in most cases, be somebody in the private sector, not the government.
Okay, so you're not talking about direct issues from the government then, correct?
I guess, that's not even necessary, because if you wanted to, say, supplement the government budget, you could issue the CBDC directly to the government, right?
Okay, this is my point, though. This is what I would actually like to see. So say additionally, say if the government did, or the central bank acquired it directly from the government, additionally, this new money could be deposited into the government's account held at the central bank for government spending. And that's somewhat what you were saying. And this would also mean an expansion in the bank's balance sheet and the central bank holding more government securities. Essentially, this would be debt-free money because any interest earned from securities is returned to the government after the central bank's expenses are taken care of. In other words, seniorage. Did I get that right?
Yeah, no, of course. I was, when I showed the government budget constraint, I was showing the consolidated government, meaning the central bank plus the central government would be benefiting from very low interest charges on CBDC, much lower than on government debt. That's implicitly, that's basically saying what you're saying here. And if it's just something whereby you give the government money to spend, then the corresponding asset doesn't even need to be a security, right? It's just a balance sheet position that you create. Doesn't even need to be a security, but yes, it could also be a security. The point is that overall the government would be able to finance itself partly at the CBDC interest rate and not at the debt interest rate, and this has fiscal advantages.
Okay, thanks.
Go ahead.
Yes, thank you.
You're in a silhouette. If you want to come close to your screen, we could see.
Yeah, I know that the lighting is not that well, so I'm not anonymous here. My name is Govert Schuler. I'm connected with the American Monetary Institute and Monetary Reform India. We are proposing, something based on the Chicago plan. And my question is, most of us read your paper about the Chicago plan. And of course, we are interested in comparison with CBDC. Because the Chicago plan, it's about no more bank runs, a more stable economy, less debt overall. So I want to know a little more comparison with CBDC introduction. At the same time, we have so-called other competitors with proposals like credit guidance, which has been effective, according to the research by Richard Werner. There are proposals for public banking. Alan Brown is very promoting that. And we have people saying through parity economics, we can have sectorial balance, and that will also solve a lot of problems. So I'd like to hear two things of you, the Chicago plan versus CBDC comparison, and if the state, and you're probably really good in able to assess that, the state of modeling such that we can compare all these other proposals too, like parity pricing, like credit guidance, and public banking. And that's my question. And thank you so much for your really fascinating and interesting presentation. Thanks.
Yeah, and thanks for the question. I think I already partly answered the first part of your question when I went through the history of how I came to this, which is that CBDC is in many ways like the little cousin of the Chicago plan, in the sense that there would be a narrow bank type feature in this economy, but it would not be all of the financial system. It would just be a part of the financial system. It would be running alongside the banking system as we've always had it, rather than making the whole banking system do something different from what it has done before, which would be the Chicago plan. So I think that's the answer to that first part of your question. When it comes to all these other things, first of all, I don't know what parity economics is, so excuse me there. Credit guidance and public banking. And your question was basically, can this be modeled and compared? In essence, if you do, first of all, if you do very effective credit guidance, then private banks become partly public because they're following a public mandate, at least partly. So those two are related. With public banking, you would still be creating a lot of private debt in order to create money, right? And a lot of debt in order to create money, which would not be true under a Chicago plan, or to a lesser extent under CBDC. So whether that is desirable or not is I think of things like credit guidance as something where you basically say we can't make wholesale changes to the banking system. It's politically impossible, but let's try the best we can do under that constraint, and then we could do something like credit guidance. This is true, but it's not my job. My job, I see my job as saying, look, what is at the outer edge of possibilities, and how beneficial is that? And should I therefore be looking further than something like credit guidance, because the benefits are so great? That's basically the way I see my work. And I am not quite sure how to model public banking, and I don't think I would have time to try and find out, to be honest.
Kirill, go ahead, unmute.
Can you hear me?
Yes.
Thanks. So many central banks have recognized the true and dangerous role of the banks, of the commercial banks. For example, the New Zealand central bank, if I'm not mistaken. Are the commercial banks really concerned about this trend? Are they controlling this process somehow? Or even are they gaining from this trend? That's the first question. And the second is—
What trend? When you say trend?
Trend to that even so many central banks are recognizing the role of the commercial banks, and the number of those central banks increases every day. This trend.
I don't know. I mean, I would say that central banks have, commercial banks have always been the main constituency, or not constituency, but the main interface in the private economy for central banks. They have always cared about commercial banks. I think what you seem to be saying is that these commercial banks have been bringing up the point of the risks of CBDC to their business model, and that's the trend that you're talking about, is it?
Yes, partly, yes. Mm-hmm.
Okay, yeah. I mean, part of this work has been about, first of all, building reassuring features into the system whereby the risk to the banks would be minimized. This is what the issuance arrangement story would be about. And then tracking what would happen to bank balance sheet likely in the most rigorous quantification that we could come up with. And we found that it would actually benefit the banks. In the short run, most banks in most countries have been fighting this, but I feel that that might be short-sighted. But anyway, continue your question.
Yeah, that was the first question. And the second is, there are mainly three problems with the current design of the retail CBDC. The first is the programmable money. Second is data privacy. Both could be misused by non-democratic regimes. And the last one is quantity cap. For example, in the euro area, they say it will be 3,000 euros per person. How likely is to introduce a retail CBDC without those three negative features?
The quantity cap I've been talking about, right? I advocate no quantity cap. I advocate instead intelligent policy rules and issuance arrangements. That doesn't seem to be where the trend is going right now, and I don't want to speculate on that. Privacy, yes, is an issue. Now, like with any economic policy that can, in the abstract laboratory of an economic model, do good, if it falls in the wrong hands, it can also be used for the opposite. That, however, in my view, is not an argument against that policy. It's an argument against whoever does abuse it. Meaning that if people are concerned about that aspect of CBDC, then they have a much bigger problem than CBDC, because there's something that then they think there's something wrong with their government, and CBDC is just one of many manifestations of that. In which case, I would say concentrate on your government and not on CBDC. And the programmable money, I'm not sure I understood that point.
Programmable money, that's the case where it can be configured so that you can spend it only in around 200 meters around your house during a let's say a COVID pandemic. You can do this or that, whatever. You know what I mean?
Okay, that's appalling. Yes, but it's very political, so no comment. Except it's appalling.
Before we move on to the next question, and Kirill leaves, Kirill did have a question in the chat that was one I had as well. I wonder if you could answer it, Dr. Kumhof. And that is that, can the introduction of retail CBDC, as I think you've advocated, but as a side-by-side model, can it eventually lead to abolishing money creation by commercial banks? If yes, how do you imagine that happening?
I don't want to speculate about that, only to say that if you can go from our current system to CBDC, and you can also go in theory from our current system to a Chicago plan. Then of course you can also go from CBDC to a Chicago plan. It's all a question of, is this politically feasible? Is this sufficiently low risk, etc.? And even the transition to our current economy to one with CBDC is not fraught with, but there are many things to think about and do right, and central banks have to be conservative about getting things right. And that should be the first step. I don't want to speculate about any further steps further into the future.
Okay, thank you very much. John, you can unmute and ask your question. You do have to.
Hello, can you hear me?
Yes. Go ahead.
All right, thanks so much. So my question's kind of dovetail with Jeff and Govir and also Howard in the chat, which is it's primarily a distribution question, but let me frame it a little bit, which is the best feature of the current system. There's lots of problems we got to fix, but the best feature is, in theory, when somebody has a productive venture, they have access to capital. They can go to a bank and they'll create the money, in theory, for something productive, which creates more economic values than the money went out the door. So they pay off the loan, they pay off the interest, they have some profits, everybody has a job. You have an ongoing economic engine to create GDP. The converse to that is when you create it for assets, you financialize assets. So somebody's already made money, purchased an asset, and now they get a loan against it. It's kind of like they double purchasing power. So the strength, I would say, that I'm looking for is the distribution question. This is a federated model we have. It's not fully decentralized. The banks have the license, but we're talking about moving to a centralized distribution model. And then specifically, the Treasury, the US, there's something economically sound mathematically about issuing this year's budget, let's say. So you're going to spend 1.7 trillion. So you borrow that, spend it, and then repay it with tax revenue, which is coming from profits. So it's linked to the economy. And you could spend that with a Treasury coin and then collect the taxes and sort of offset it. That makes sense to me. Expanding either Treasury issuance beyond that is, to me, there's no connection to the economy. And I don't know how that money would get out the door. And that's the same concern I have about CBD, central bank digital currency, is how does it get out to the periphery, the economy, from a centralized architecture that can actually capitalize all the needs to optimize economic output, not the asset investment side, because there's 30 trillion in US debt. And if we let CBDC go there, those bonds have a purpose, is that the trade deficits, people have excess cash, they buy those US instruments to bank their money, and that actually comes back to us. So if they didn't have those to buy, they might devalue the dollar by buying non-dollar assets or whatever. And I can't go there right now. I really appreciate what you've done. Let me say thank you. And I'm going to study it in more detail along with Jeff's work. But keeping it, letting it go to government debt seems really destructive. Using it for bottom-up spending seems really positive. And CBDC coin is different than Treasury coin. So in there is a distribution question. So let me just turn it to you.
Can you clarify one thing? You say CBDC coin is different from Treasury coin because the issuer is the central bank rather than the Treasury, and that makes a difference. Why?
Well, because in the U.S., right, the Fed is not the U.S. government. It's a central bank, but we could discuss whether it issues money or not, how it works. But for the Treasury, there's a lot of people on this call and a lot of movement in the Positive Pangar and everyone else is they want debt-free money for we the people. So you could do that, and as you've said, if they get it from the Fed and they pay an interest, a wholesale interest rate, and the Fed has excess money, they send it back to we the people. So I don't have a huge difference between that. I see your point, but when the government would be issuing more than they're collecting in taxes, they would literally have no link to the economic process. they would just be printing money. And the issue with the central bank digital currency is, what is their link to the real economy? If that flows through intermediaries, or it's direct and it gets to financing businesses and restaurants and things, that's connected to the real economy. But if it just goes into financial assets, then you're just changing the distribution of real economic growth of who gets the winning, and you're printing, you're replacing assets with liquidity. So you're doing some type of QE, right? So there's a balance between all the debt in the world and what it's capturing through servicing that debt, and the real economy, which is producing all those values that we eat. So the question I'm asking basically is, how does the central bank currency get out to the real economy so we don't have a credit crunch like we're having in the US?
Yeah.
And the fiscal economy, spending, is different than the lending economy. Investment money and purchase money behave differently.
Yeah, there's a lot to unpack in your question, and so I don't quite know where to start. But it going into financial assets, what does that mean? CBDC going into financial assets. If bank deposits go into financial asset, then basically what you're saying, okay, the banking system buys a financial asset and creates new money to buy it, and so that's how money goes into financial assets, or it does the same.
Into instruments, yeah.
Yeah.
Cash equivalents.
With CBDC, the only way this could happen is because the issuer is no longer a commercial bank, it's the central bank. It's the only way this could happen is if the central bank itself were to purchase a financial asset and issue CBDC against it, which, basically my idea is it would only do that against government securities and not against all the universe of financial assets that exist out there. So it would not, the issuance by the central bank or by the treasury would not per se stimulate any kind of private financial asset production, because it would only be against government debt. But your question is broader, and it goes on to, basically you think of money as the lifeblood of an economy, and how does it get to the right organs kind of thing. And my first response to that is always, and money is fungible, meaning that once it's out there, it's going to go where it wants to go and where the incentives of the private sector are. Although that's not quite true, because I've argued, for example, with Richard Werner about this, because he starts on the credit side and he has this credit view, and that the lending matters. But in my view, who do you lend to? It matters when you create the money. That's true when the velocity is very limited and it's lent once and the money is then used and thereafter it stands still. But that's not true. It actually, there's a velocity and the money circulates around. But there is a point of the first round matters. I mean, when the money is first created, where it goes does matter, because the velocity isn't always very high. And so there is a point for arguing we should make sure that when it goes out there, the very first step is a good one. It goes to the right place. But I think if it goes to the government to finance part of the budget, then you would have to say, okay, let's hope the government does a good job, right? Let's hope the government puts it into places where it ought to be. And that's a democratic thing, right? Do we have enough democratic control over the government to make sure that that happens? If CBDC is issued just against government securities, it doesn't go anywhere. Somebody has a balance sheet, has government securities on it, and after this transaction has CBDC on it. What happens next? That is the question. And that's no longer up to the central bank, right? It's no longer up to the issuer. It's up to the person who acquired that CBDC.
So my concern, which you see today in QE, is once it goes into the financial economy, buying instruments, next thing you know, it's stock purchases, it's inflated real estate, it's stock You know, it's financial asset appreciation, and none of that's going to build supply chains or create real world jobs. So this is the distribution question with all the problems of the current banking. In theory, right? Anybody can walk into a bank today, and if they have the experience and meritocracy, they can get access to capital to grow the real economy. And that part I don't want to throw out. And that's always what's held me up about centralizing the money supply, is if we let it go to the financial economy, we get none of the benefits, and we don't get all the economic growth that's there to have. If it comes up from the bottom, then I think eventually you're right, it will trickle into these assets, but it'll happen differently because it'll be connected to real economic growth. And that's the question I would suspect for further research might be interesting. Go ahead.
Yeah. You have to, of course, say that, you know, I was in banking in the late 80s, early 90s, and you know there was a lot of lending to the real economy, etc. But if you look at the share of bank lending that actually goes to real economic activity rather than to financial purposes, as you were implying, it has become a relatively small share, and that's a problem. But how do I make sure? You know, I don't really, all the central bank or the treasury, depending on who does this, can do is to make sure that there's a part of the money supply that's issued by them and that has the benefit that are pointed out in this paper. Now, if you take that argument to the limit, if you go to a world where this becoming bigger and bigger relative to the banking system, and in the limit you have the Chicago plan, then there's another argument that you can make, that I often made when I first came up with the Chicago plan, which is this. In today's economy, lots of potentially very productive actors are very weighed down by debt, right? Because the only way to create the purchasing power in the economy is through debt. And that means even though we may have quite a bit of purchasing power floating around there, we also have an enormous amount of debt floating around out there. If CBDC were to become something really big, then you would be able to have debt-free money that has not been created through somebody else's debt. It has in fact been created by withdrawing some debt from the economy, government debt, and it could also be, depending on what the government does with all that, it could also be shared with its citizens, and there could be less private debt. So what you would then do is you would have more debt-free money, and then I think having your money supply created with less debt would itself do a lot for efficiency of allocation. It would remove constraints from people that are now seriously constrained. Beyond that, I don't really want to argue that money creation should be more than just money creation, because if I take your point seriously and say, as a policymaker, I want to do something here, then I want to micromanage where my money creation goes and not leave that to the private sector. I'm not sure. That's a different question. I think then you would have to reform the financial sector or what have you, or create a public bank. Because a public bank can say, okay, this is where it would be efficient if you trust a public bank. But it's a separate question. I think it's a separate question from money issuance.
I just don't know how it gets out the door. How does the central bank get money out the door?
Door is not a problem, right? Because if you issue it against government debt, somebody will be holding that money. The question is, how does it move around from there?
Okay, thank you. Appreciate it. Yeah. Really appreciate the paper and the work you're doing. Thank you.
Okay.
Thank you, John. Important question. There are 3 more people in the stack, and then we will wrap up. Go ahead, Georg.
Fascinating discussion. Thank you very much for an interesting talk. So I have a question on a modeling decision. So I wonder why you model CBDC and central bank reserve separately. Whether you could expand a bit on that decision. So it seems that one target you have is to pay different interest rates on central bank reserves and central bank digital currency. And I'm wondering, like, given both of them are high-powered money, could commercial banks just shift into central bank digital currency in case that interest rate get more attractive for them? And so I'm wondering, like, how tenable is this distinction, maintaining this distinction in your model between central bank digital currencies and central bank reserves? Thank you.
Yeah. Now, let's make sure we're starting on the same page, and let's imagine ourselves in a world of not at the zero lower bound on nominal interest rates, so that interest rates are significantly above zero, which is where we're going right now. Because at the zero lower bound, some of the arguments become harder to make. So now, what determines the interest rate on CBDC? If you were to just fix the quantity of CBDC and let the market find the interest rate at which it wants to hold it, then it would come out to somewhere near the interest rate paid on checking accounts, I would argue. Now, historically, the interest rate on checking accounts, or no, the interest rate on bank liabilities, on the average portfolio of bank liabilities relative to risk-free assets like government treasury securities in the United States has been something like 150 basis points. And if you just look at checking accounts, it's more like 300 basis points, something like that. So there's a significant difference, meaning that the interest rate on CBDC, if you wanted a certain stock out there that's not infinite, just a limited stock, people would be willing to hold that at an interest rate that's, people who use that money as money would be willing to hold that at an interest rate that's similar to that on bank deposits, and thereby significantly lower than the interest rate on risk-free assets, right? Now, if you now look at banks, commercial banks, they don't need to go out and use their reserves to buy a burger, right? They don't need retail money. They need wholesale money. So the interest rate on that they want for their reserves is very much higher. They wouldn't want to hold something that pays 150 basis points or 300 basis points less, because they don't have to make those purchases, those retail purchases that you and I have to make with our CBDC or our bank deposits. So the marginal holder determines this so-called convenience yield, which is the difference in interest rate between a pure savings asset and a monetary asset. And the marginal holder is you and I, not the banks. But that also means that the banks would not be willing to hold this stuff. They would want to hold their reserves, which is sort of the rate at which they lend to each other, and at which they transact with the central bank, and that would be significantly higher. Now, something that I didn't get to talk about in my presentation, because time was short, we actually analyzed the case that you are implicitly talking about, which is to say, let's just merge everything. Let's just not even give banks the option of holding high interest reserves anymore. Let's say they have to settle all their stuff using CBDC. CBDC with that high convenience yield and therefore very unattractive interest rate. What would happen? Well, if that's what happens, then what the central bank would now control is the interest rate on CBDC, which is an interest rate on money. It would thereby no longer control the risk-free interest rate on a saving instrument. It would lose control over that. The market will determine that, because the central bank now merges these two things. It has been controlling the risk-free interest rate through the interest rate on reserves and the interest rate on money through the interest rate on CBDC. Now you're throwing all that into one pot, and you're only controlling the interest rate on money, and the risk-free interest rate would be determined in the market. And what we show in the paper is that this is inferior to actually controlling both rates separately, because it gives, you have those two policy tools. There's a very good economic reason why reserves and retail money should be different things. Use it. That's it. That's all I wanted to say. Thank you.
Thanks, Jared. Great question. Joe, if you want to be in the chat, you have to unmute and show your video.
Okay, I'm just.
Can you show your video?
Well, I'm on the road here. I'm driving. That was a great presentation, Michael. Really good. I assume it'll be related to your coming June 15th participation in the Harvard or Cambridge conference.
Yeah, I'll be participating. I'll be participating in Hamburg.
It's really well done. My question relates to something you raised earlier, and you just talked about now, the Taylor rule and the payment of interest on settlement balances, is what we call in Canada, or reserves. That just seems so unfair. The banks sell their very liquid government bonds to the bank, the central bank, and they get in return an even more liquid asset, settlement balances or central bank money, and yet they earn this high interest on it. And I just wondered if you felt that was a little too generous to the banks and a little unfair to the public that loses all the interest that the bonds they've been purchasing, the central banks have been purchasing for the system. They lose all that interest. And in fact, that interest gets paid back to the banks and more. Thank you.
Joe, I work for a central bank. You really think I'm going to answer that question?
Oh, I'm sorry. Anyway, a great presentation. Thanks so much. Best wishes.
Okay.
So I think that may have been the last question. Somebody was on the chat, but
Frederick, we have almost gone through all questions. So
yeah. So go ahead, Samuel.
Yeah, many thanks, Michael, for writing this paper and for taking time to coming to us and have a great talk about it and for answering almost all the questions here this evening. We are super happy that you have taken this time to do it. And also thank you to all of you that have come in and listened to this webinar this evening.
That was an impressive attendance. You were right, about 130 people were there at the beginning. That's
yeah, it was my estimate based on previous numbers, but something, yeah. So
I just would like to say one final word. It's great to see you here, Dr. Kumhof. Recall seeing you many times at AMI, and you know, I think the interests of monetary reform groups are in people and planet, and not in the survival of banking as we have it currently, which is not to say not in support of financial intermediaries that help us to engage in using our savings for future investments and future purchases. And your presentation was hard for many of us, speaking myself at least. It's one I will go back and watch again and read your paper. And I just would ask you as a person, as a fellow AMI intender, as a person in this webinar, keep in mind people and planet and all the survival of the species that I know you appreciate, because I know from conversations with you, you are a camper and a survivalist, and you appreciate nature, and blessings in your work, gratitude for your work, and stay with us and stay in dialogue with us. Thank you very much.
Thank you. Those are kind words. Thank you very much. And I will.
Thank you.
And thank you, Samuel, for your excellent organizing as the lead IMMR group in this webinar and your preparations for it. Kudos.
Thank you for helping me with this and
absolutely
everything. Yeah, I'm sorry for not being able to speak English and express
You've
my
done
gratitude
great.
in the way you can do. But I'm also very happy with this. Everything
Absolutely. We can stop the recording, and thank you everybody for attending.